All right. Well, happy Friday, everybody. Congratulations, you made it through another week. We are delighted that you are spending your Friday morning with the U.S. India Chamber of Commerce. My name is Neil Gonagumpla, and it's my pleasure to welcome our friends from Whitley Penn to provide us with a webinar on PPP loan forgiveness. As we know, this has been a very interesting time where many of our businesses have been operating with little information, and so we're very honored to have some of our experts in financial and tax services to provide us with an update on business considerations for PPP loan forgiveness, things that we need to be thinking about and aware of as we continue forward through this very unprecedented time. I also wanted to mention that today's program is being recorded, and a recording of this program will be available on the Chamber's YouTube channel. You can go to YouTube and search USICOC, DFW, or U.S. India Chamber of Commerce, and the webinar recording will be available for you there. Additionally, you can find other recordings of programs that we have done during COVID-19 there as well. There are a number of webinars on legal considerations, labor and employment considerations, banking considerations, and other things that may be equally relevant to you. So keep an eye out for those. Finally, I wanted to share that next week we have a webinar series starting for young entrepreneurs and professionals on finance. And so it's really Finance 101, things that people need to know as they're embarking on their financial journey towards long-term savings and retirement. And during these unprecedented times, there have been a number of opportunities for people to start engaging. And so we want to make sure that our young entrepreneurs and professionals are geared up and ready to take advantage of some of the opportunities that are available today. So without further ado, I want to welcome John Karp and Kristen Syed to this webinar. John is a CPA and PFS. He has more than 25 years of tax advisory and financial services and public accounting expertise, focused on C corporations, S corporations, partnerships, and high net worth individuals. He primarily works with clients in the energy, healthcare, manufacturing, distribution, and retail space. He also supports nonprofits, professional services, and real estate, as well as the construction industries. And most excitingly, John is currently the chairman of the Texas Hall of Fame. So we're really excited about having John with us today. And Kristen Syed is a certified public accountant. She's been with Whitley Penn since 2011. Most of her practice has centered on working with entrepreneurs, closely held businesses, and high net worth individuals, focusing on estate planning, financial planning, income tax planning, and professional accounting services. So John, Kristen, without further ado, thank you so much for joining us, and the screen is yours.
Great. Just a small correction. It's the Texas Business Hall of Fame, just in case, because I'm not sure what the Texas Hall of Fame is. So we're going to take a walk through today, the PPP loan forgiveness application. We're going to give a small disclaimer to this because we were preparing for this, and then I don't know if anybody paid attention to news feeds, but comes out on Wednesday evening some modifications in a tax and some legislation. And so, as Neil said, we're business advisors and tax advisors. What I want to make sure everybody understands is this whole idea of how we're running this SBA stuff makes anybody who's legal or a CPA kind of queasy, because there's no real law to it. And in fact, you have frequently asked questions, which actually changed the law, but they say use the frequently asked questions to give you guidance to the law. And sometimes they're at odds with each other. And the reason why I say that is because nobody likes operating outside the law, and that's what frequently asked questions are. And as anybody can tell you who deals with the IRS, if it's not in the law or it's not in an IRS document, and even some IRS documents, they tell you, well, you can't rely on those documents. So just realize there's a discomfort by everybody who's dealing with this at the moment. And so hopefully we'll get some other guidance in some of this. And they're supposed to come out with some more frequently asked questions to give us more guidance. And so we'll talk a little bit more about what to do with those FAQs if you're relying upon them. All right, so here's what we're going to just do today. A table of contents here is we're going to look at just a quick brush up on the Economic Injury Disaster Loan and Emergency Economic Injury Grants, the Paycheck Protection Program Loan, Loan Forgiveness Application, and the Paycheck Protection Program Flexibility Act of 2020, which is what came out on Wednesday. And so with no further ado, the first section is the Economic Injury Disaster Loan and Emergency Economic Injury Grants. And so what were those? In fact, this, if everybody remembers, everybody flooded the websites and you put in for what was called the EIDL. And what was it? It was a $150,000 loan, and it was originally supposed to be $2 million. It was going to be a 30-year term, 3.75% interest. Folks are just now getting these funded. I've heard some got funded right away. Then there was this pause. And then I know several people who have been getting funded for this now. So who is eligible? It was small business, including sole proprietors, independent contractors, cooperatives, private nonprofits, tribal businesses. Here's the bad part about this. If you didn't apply at the very beginning, and unless you're in the agriculture business, then you're done. So unless you're in production of food and fiber, ranching, livestock, you really can't apply for this anymore anyway. But if you were wondering because you did apply and you were silent, I had a client the other day get an email from the SBA that said, hey, we have declined your loan. We're not going to give it to you. We see you have some credit problems, but you can appeal that decision and have it reconsidered. And so they're in the process of reconsidering his loan based upon some other documentation he has. But again, that's the loan program. The second part of that was the grant. And the grant came out and they said, we're going to give you $10,000. And then they changed that to $1,000 per employee up to 10 employees. And this does not have to be paid back by any circumstance. This becomes a very important number. And what I put down below is what that grant, if you got that grant, what it would look like as it came into your bank account. So, you know, if you have a lot of activity in your bank account, then you may have missed something. If you put in for one employee or two employees, you may have wondered why you got $2,000 or $1,000 into your account. And again, this does not have to be paid back. Any loan made under the EIDL program will not require a personal guarantee if it's less than $200,000. And we showed you where to, there's the disaster loan where you could go apply. So really it's only now if you're in the agricultural business, if you hadn't applied for that. Any amounts received as the EIDL grant, which is why I put that up there about the banks, is because anything you receive in the grant is going to reduce your PPP forgivable portion.
That's right. And so that's why we really wanted to talk about the EIDL grant because we're going to look at it when we get into the application portion. Moving on now to the Paycheck Protection Program loan, just to give a little bit of background information before we dive into the forgiveness part of this. This was $660 billion in loans available to businesses with fewer than 500 employees, sole proprietors, nonprofits, and you must have been in operations as of February 15, 2020. It's 100% guaranteed by the federal government through December 31st of 2020. No personal guarantee was required, and the interest rate is 1%. The proceeds can be used, and it's very specific, to cover payroll, mortgage payments, rents, or utilities, and any other debt service requirements. That's going to be outside of the forgivable portion, so we'll talk about that more in a little bit. Zero loan fees, zero prepayment fees. Payments for any loan amount not forgiven can be deferred a total of 6 months to 1 year after disbursement. That's what the rule was until Wednesday night. And towards the end of the presentation, we're going to go over the changes that Wednesday night brought to us. Because the president still has not signed it, we are presenting this as if the old rules really apply, and then we're going to show you what the new rules will be and how they'll take effect when he actually signs it. If you have not applied for the PPP, you can apply now. You just need to find a bank to accept your application. The loan size for the PPP is 2.5 times your average monthly payroll cost. And there are several things that are listed in there. We can give you access to these slides after the presentation because there will be a lot of details that you'll want to go back and either watch the presentation again or refer to the slides that we have. But just to run through them quickly, the payroll costs include compensation, sole proprietors or independent contractors, it's wages, commissions, any other income you receive from self-employment capped at $100,000. It'll include payment for vacation, parental, family, medical, or sick leave, an allowance for dismissal or separation, retirement benefits, and state and local assessed compensation of the employee, tax assessed on compensation of employee. It does not include payroll taxes, compensation to an employee whose principal place of residence is outside of the United States, or any qualified sick leave or family medical leave for which you received a credit under the Corona Relief Act. So you can't include those costs in this either. How can the loan be used? They are very specific about this. Unlike the EIDL that can really be used for any business purposes, the PPP can only be used for payroll costs, as we noted above, continuation of group healthcare benefits, employee salaries, commissions, or similar compensations, payments of interest on mortgage obligations, which do not include prepayment or payment of principal, rent, including any rent under a lease agreement, utilities, and interest on debt obligations that were incurred before the covered period. And as we go through the presentation, we'll touch on areas where they've given us more definitions for these, but these are the broad categories that it could cover.
Right, and recognize just because we're saying the loan can be used doesn't necessarily mean the loan can be forgiven for, right? So that's some of the guidance we've been given. And that's actually coming straight from the CARES Act law legislation. So some popular questions we've received over from some folks as we've been giving these is, do we have to maintain staff through June 30th or just an 8-week period? And again, we'll talk about that because some of the legislation that just passed talks about a 24-week period, but I don't want to confuse what's going to happen, because if you had your loan before the legislation was passed, of course, we're going to need some FAQs and some guidance on this, but you can stick with that 8-week period, which would lead you to believe that June 30th would still be your date. So the forgiveness is only determined based on that 8-week period. Do all employees need to return at the same time, or can some stay on unemployment? So since we're in Texas, if you even pay attention to some of our news media, they've even talked about the Texas Unemployment Commission, that they've said, if you get offered your job back, you can't stay on unemployment. And the SBA has reiterated many times that no one can choose to stay on unemployment. And also, if you've offered a job back to someone and they've declined the offer, one is you need to make sure you save that documentation, save that email, because it will not count against you as a decrease. And we'll talk about when we go through the application what that means as far as the decrease. And then how soon do I need to rehire someone that was let go? Well, here's what's really interesting. Guidance is really silent on this, and you don't really have to hire the same people. So you just have to maintain your FTE count. And so if you have someone who made $4,000 a month, it just means you have to hire someone else that makes $4,000 a month. It's all about the FTEs. Can I include part-time employees in the forgiven wages? Everybody's included in this dynamic. So the answer is yes. And then let's say I received $850,000 for the PPP, and after 8 weeks, I only used $600,000. Will the $250,000 I didn't use turn into a loan, or will I have to return that $250,000? The answer is it turns into a loan, but also check your loan documents to see if you don't need it. Most of the time you can return it without penalties. So what we found is a lot of people are trying to figure out if they're going to keep the money or if they're going to give it back if they don't need it. And then what is included in the utilities and transportation costs? I'm going to be the first person to say we really don't know everything. Like, certain things are really easy as far as electrical, water, gas, telephone expenses, but the SBA has yet to issue guidance on transportation costs. So we have seen someone else's opinion that said transportation costs being defined as the same as tax law, which would allow for either the standard mileage rate or the actual expense method. We had a question that came up yesterday that someone said, well, what about if you just think about the oil business, what if you were putting diesel fuel into a generator? Would that fuel cost be considered utilities? And if I would think you might be able to squeeze it in there because that's your operations of electrical and utility costs, but it's very vague at the moment. So until we get some other guidance, that will be, just recognize how vague that is.
Okay, moving to the actual loan forgiveness application, and just a few housekeeping items on this. Again, we're gonna walk through the forms and show you snippets of the form and our understanding of how it works and everything. And we have not updated this for what was passed on Wednesday because we really think that the mechanics of a lot of the calculations are going to remain the same. So you need to get familiar with those and know what you're going to have to do. It's just some of the details on time periods or dates that are going to change. So we left this part of the presentation the same as if the act had not passed the Senate, but the mechanics are still going to be the same. Much like John's used the analogy for tax forms, we do expect the form to have to change because some of the line item factors are going to change, but the rules are going to remain pretty similar. So this application was released on Friday, May 15th, and we were kind of anticipating at the time, there was this talk out there of 30 FAQs that were going to be released any day to support the application. It's now June 5th and we still don't have those FAQs. Now people are thinking they knew that the act was going to probably pass and we're waiting. So it's one of those things that John and I go to sleep every night and wake up every morning checking our phones to see if anything from the SBA has come out, but it still is not there. So we're presenting what we know today. The application has 4 required forms: the PPP loan forgiveness calculation form, that's the main form, representations and certifications, a form that they're calling Schedule A, and then they also have a Schedule A worksheet. And finally, there is a demographic information form, but this is optional, so we're not including it in the 4 forms. Looking at the calculation form, this is the front page of the main application. Obviously, you start with your business name and business address. You are going to submit this application back to your lender. It doesn't go directly to the SBA, so continue to have that relationship with your lender. Walking through a few sections of it, you're going to enter the PPP loan amount. This is the maximum amount that's going to be available for forgiveness, and the date you receive the funds. This is generally going to be the start of your 8-week period, but we will talk about where there could be exceptions to that, but they do want to know your disbursement date, so you'll disclose that there. Also, they've asked for the number of employees at the time of your loan application and the employees at the time of the forgiveness of the application. We don't see why this matters at all for the application, but it's on there, so we suggest you put it there.
So if you receive the EIDL grant, what the advance amount, they need that information because they're looking at what you have to reduce your forgiveness amount by. And remember, that was by employee. So, and again, that was just that number. The application number, this was what was really interesting, is a lot of people probably had no idea what their application number was. It did come up with a number after you applied for it. Hopefully you took a screenshot, or hopefully when you got an email, because you had to put your email in there, there's a number associated with it. So again, you're gonna need that information for the loan. So the SBA, if you look at the second section, it's your payroll schedule. And here's what's really interesting about this. The way this really works, it's not 2 months of payroll. It's really looking at weeks. And remember that 2 months does not equal 8 weeks. So there's about 4.2 weeks in a month, approximately, depending on your month, right? I think February at 28 days is the only one that has exactly 4 weeks. So they're going to use this to determine when the payroll costs are paid or incurred and eligible for forgiveness, and will be used in calculating that FTE, the full-time equivalent. And you're going to want to make sure that you pay attention to weekly, bi-weekly, and twice a month, monthly, and other. And that's going to be giving the SBA or your lender, really your lender is the one who's going to process this application, the information to be able to process your payroll of when it's paid or incurred. This also dovetails into some of the rules that we were all hoping and guidance that we were hoping that they were going to come out with. Let's say you had a biweekly payroll, but the payroll period ended on April 6th and you got your money on April 7th. Well, if you don't pay the payroll until April 8th, then that paid amount could be included in the forgiveness calculation, even though it was incurred in a prior period. And it's going to be the same thing going forward towards the end. If you go down to your covered period, that's the 8 weeks beginning the date you received the loan disbursement. So the day the money hit your bank account was the day you were supposed to start using it. And that's been some of the fears, is that what if your business still isn't open, right? So what are the covered period rules? It's only costs paid or incurred within the 8-week period are eligible for forgiveness. And so those are specific for payroll costs. Payroll is considered paid on the day the paychecks are distributed, or the borrower originates the ACH credit, because sometimes that's a couple of days before. As I said, you could go backwards, right? If you looked at the example I gave you. So what we don't know is how far back can you go? So could you pay the last 2 weeks in March? Could you pay all of March if you closed March 1? I recognize most people didn't close March 1, but could you do that? Payroll is incurred on the day the wages are earned. Now, specific to mortgage, rent, and utilities, you are fine if it's paid during the 8-week period. You also fine if it's incurred during the 8-week period and paid by its next regular due date, even if it's outside the 8-week period. And for mortgage, remember, it's not the principal payment, it's the interest payments. And you can use the funds, you just won't be forgiven for any principal that if you just as your payment amount. And then the rent has to be an eligible lease.
Yeah, so one thing that came out with the application was this thing called the alternative payroll covered period. And this gave some flexibility for when the 8-week period would be specific to payroll costs only. It allows you to choose this if you have a biweekly or more frequent payroll schedule. And this won't apply to your rent, mortgages, or utilities in the calculations. And if you go with this alternative period, you're going to use that period anywhere the rest of the application says alternative period. We think the use of this alternative period is going to be different, or not as much now that they've extended it with the new law. But basically, if you receive the funds on April 3rd and your normal payroll period starts on April 5th, if you wanted to delay your 8-week period until April 5th, this would allow you to do that. We've had some clients ask, when would you want to? What are the circumstances? And you really just have to lay it out on a calendar and say, where were my costs? When did things incur? When did I actually pay things, to see if you could receive a benefit here? Here. But again, it may not be a factor now that we have the extended weeks with the new, assuming the new act passes. Finally, the top portion of this has the row that says, if borrower together with affiliates, if applicable, receives the PPP loan in excess of $2 million, check here. We know that there's a safe harbor at $2 million. Do not check this box if you receive less than $2 million. You wouldn't want to throw up a flag to say, come and audit me because you have this box checked. That's basically what it's going to do. So don't check it if you're a small borrower.
So now let's get to calculating, and we're going to start with the calculations on the Schedule A worksheet. So there's 4 computations, right? So one is your eligible compensation for each employee. You calculate the compensation cap of $100,000 per employee on an annualized basis. You determine the number of FTEs, and then you use the FTEs to determine if a reduction of the eligible forgiveness is required. So the first is you have to go through and identify each employee, but do not include independent contractors. They're not eligible for forgiveness here. Self-employed individuals, forgiveness for payroll cost is 8/52 of line 31 of the individual's 2019 Schedule C. And again, we'll talk about how this is handled. Owner employees, these are included later as well. And by the way, when we look at owner employees, there's not great guidance on this. So I've heard 2 different scenarios. One is, it doesn't matter if you're an owner of an S Corp or a C Corp, you belong in here. And the other one is, it's just an S Corp. It doesn't define it. So then you have partners, and these are included later as well. So you don't include any of these four in this calculation, in this table. So if you look at this table, it's pretty clear there's list employees with annualized compensation, all pay periods in 19, less than $100,000. There's no guidance on bonuses given. However, that may work to your advantage if with the bonus, it's over $100,000 because of how we can use the numbers for people who are compensated over $100,000. If you go down to the table and you see what the employee identifier buried in the directions, that's the last 4 digits of your employee's social security number. So make sure you have that when you're ready to fill this out as well.
So now we're going to dive into the details of this table 1 and go through each of the columns and the calculations involved. And keep in mind, you have to do this in table 1 for every employee that earns less than $100,000. So this is on an employee by employee basis. All these calculations we're showing, you're going to have a spreadsheet, and if you've got 50 employees, it's going to be pretty detailed for doing these calculations at each level. Cash compensation includes salary, wages, commissions, or similar compensation, payment of cash tips or equivalents, payment for vacation or parental, family, medical, or sick leave, and allowance for dismissal or separation. Do not include anybody that makes more than $100,000 in this table 1, and recognize that you should not enter more than $15,384 in this column for either table 1 or table 2, because it's only the 8-week period of $100,000 that can be part of the forgiveness. Now, will that change with the act that just passed? Possibly so, but again, just keeping with how things were since it's not signed in yet. You're also not going to include any compensation for an employee whose principal place of residence is outside of the U.S., or if you receive the family leave wages or sick leave wages credits, you're not going to put those in here either. The next column for table 1 is the average FTE. To calculate a FTE, it's going to be your average number of hours worked during the cover period or your alternative period, and divide by 40, rounding to the nearest 10th. The maximum amount for each employee is 1.0. They are allowing you to use a simplified method where you get to say every employee that worked 40 hours gets a 1.0. If you worked less than 40 hours, you get a 0.5. However, we're going to show in this example that it may be worth it to you to go through and do the detailed calculation. We did take this example, Forbes.com, and Tony Nitti is an excellent writer for Forbes, and our examples all came from him, so we wanted to give him credit there. In this example, employee A works 60 hours. Their detailed calculation would be 1.0 and their simplified would be 1.0. Pretty straightforward. Same for employee B who worked 40 hours. Employee C who worked 28 hours, the detailed version would give us a 0.7 calculation, 28 hours divided by 40. The simplified version would just give us a 0.5. And we have a few other employees up there. And if you get to the bottom, you see that the total for the detailed is 3.7 and the total for the simplified is 3.5. So in this case, if it's worth your effort, you want this number to be as high as possible. So it's probably worth it to go through the calculation and use the detailed, but it would be up to your individual circumstance to figure that out.
So now let's look at the salary and hourly wage reductions. So the loan forgiveness will be reduced by any reduction in total annual salary or average wages of any employee during the covered 8-week period who did not receive wages or salary in 19 of more than 100,000. So if you remember when I made the comment about earlier about if you had a bonus, since they've kind of been silent to this, and your employee comes out to $105,000 or $110,000 of annual compensation in 19, well, they don't figure into this calculation, even if you reduce their comp to lower than 100, or you reduce their comp just to 100. So that $10,000 differential between their bonus and their regular comp doesn't come into play. So reduction is required if the reduction in wages is in excess of 25% of the total salary or wages from January 1st, 2020 through March 31st, 2020. So the steps to determine the amount of the reduction must be done, again, by employees. So if you have 100 employees, I hope you have some really good printouts to give you this information, because it's going to be an arduous task. So it's determining, so you have to determine the average annual salary or hourly wage for each employee during the 8-week period. You determine the average annual salary for each employee from the 1st through March 31st of January 1st through March 31st, 2020. You divide step 1 by step 2. If step 3 is greater than 75%, you're free and clear. There's no reduction. You don't have to worry about that column. If step 3 is less than 75%, then you have a reduction, and you'll see how that works. So stay tuned. Next slide. So tentative limitation calculation. So if step 3 is less than 75%, for a salary employee, you multiply that amount determined in step 2 by 75%, subtract that result, the amount from step 1, take this result and divide by 52, then multiply by 8. For an hourly employee, you calculate the average number of hours worked per week from January 1st, 2020 through March 31st, 2020. And again, you multiply 75% of step 2 less step 1, and then take this result and multiply by 8.
Okay, I'm sure everybody heard that and just completely understands how to do the calculation now. Extremely simple, right? Obviously, they put some thought into what all needs to go into this. So we've again taken an example from Forbes and Tony Nitty here that I think you're just going to have to refer back to, but we'll walk through it with your, refer back to it with your own situation. But annual salary for 2019 of $100,000, employee A here, they were paid $20,000 from January 1 through March 31st, 2020. And they were paid $8,000 during the 8-week cover period. So in step 1, determine the average annual salary or hourly wage for each employee during the 8-week period. That's $8,000 that they received in the 8-week period divided by 8 multiplied by 52. It's $52,000. The average annual salary between January 1 through March 31st is their $20,000 multiplied by 4, which gives us $80,000. We divide step 1 by step 2. If it was greater than $75,000, it's fine. No reduction is required. But that's not our case. And so we go down and we multiply the amount determined in step 2 by 75%, which gives us $60,000. We subtract that result from step 1, which is $8,000. And this gives us what would look like limiting factor of $1,230. But of course, there's more. An additional safe harbor. No reduction is required if the safe harbor is met. Remember on the slide John touched on, we said could be reduced. The safe harbor calculation is going to be done by determining the average annual salary or hourly wage as of February 15th. Then you determine the average annual salary between February 15th and April 26th. If step 2 is greater than step 1, the safe harbor does not apply. If step 2 is less than step 1, you get to look at the average annual salary as of June 30th. And if that amount is equal to or greater than step 1, the safe harbor has been met. Now, keep in mind this June 30th date, just make a note that it's one of the dates that changed when we get to the act later on. So this is how it currently is, but make a note, you may have to look at that date change later. So we have an example of this. As of February 15th, the annual salary was $75,000. The average annual salary between February 15th and April 26th was $55,000. Step 2 was less than step 1, so we keep going. The average annual salary as of June 30th was $75,000. So because that amount is equal to or greater than step 1, nothing has to be put in the salary hourly wage column. And if it was not met, then 1,230 would go there. But you can see that we've met the safe harbor, so we went through all those calculations to just ultimately put 0 in the column. The instructions on the forgiveness application do lay out how to do this for hourly employees. Our example shows salary, but you can certainly refer to the application to see an hourly one.
Table 2 lists employees with annualized compensation of more than $100,000. So total compensation costs for these employees for an 8-week period cannot exceed $15,385. And so this is important because this is where, if you remember, you could have reduced these and it doesn't matter. So there's no wage reduction. So that's a really good part of table 2. FTE reduction safe harbor. Remember, loan forgiveness can be reduced if your pay or head count, so your full-time equivalent, reduces during the 8-week period. And there's 5 steps to this. So forgiveness will be reduced if your average number of FTEs during the covered period is less than the average during the following periods. Now you get to choose here. So you can look at beginning February 15th, 2019 and ending June 30th, 2019, beginning January 1st, 2020 and ending February 29th, 2020. For a seasonal employer, check the SBA definition, but either you can choose 1 or 2 above, or any 12-week period between May 1st, 2019 and September 15th, 2019. And so what does this look like? So here's the example. This looks very similar to our payroll example. So you're going to line up your employees, right? Hours worked are 60 equals 1, 45 hours equals 1, 40 hours equals 1. And again, you want to get the highest number you can. So our detailed FTE account here works out better if you go to the bottom. So the loan must be reduced by multiplying the costs eligible for forgiveness by 3.7 and divided by 6.4. And again, this came from the Forbes article that Tony Nitti wrote.
So we would normally have that reduction, but of course, because nothing seems to be simple with this, there's a safe harbor. Before you do that reduction, you get to look at 2 additional periods. Period 1 is February 15th through April 26th. And period 2 is the pay period, whatever your pay period is, that includes February 15th. If your average FTEs for period 1 is less than period 2, then compare period 2 to your total FTEs as of June 30th. And if June 30th is greater, you don't have to do a reduction. Again, this June 30th date will be one that changes if the act is signed, but right now it's June 30th. Basically, if you can put all your FTEs back to at least what they were for period 2, the pay period that includes February 15th, by June 30th, you are good even if the February 15th is less than 2019 or the first 2 months averages. Other considerations, and we've gotten a lot of questions on these, so things that will not reduce your FTE count. If you've made a good faith written offer to rehire an employee and the employee rejected, that's not going to reduce your FTEs. If you need to let someone go for cause during any of these periods, that's not going to reduce your FTEs. Or if an employee voluntarily resigns or voluntarily asks to receive a reduction in hours, that will not reduce your FTEs. So if any of these apply, keep in mind that you'll keep the FTE number for that employee the same. Just be sure to document that you've made a proper written offer, or have the documentations for the for cause firing if that needs to happen. So that's all of the worksheet. Going back now to Schedule A, not the Schedule A worksheet, we'll work through how that one works now. And again, we're still not to the front page where the actual application is yet. This is just Schedule A. The first half of Schedule A is going to be pretty straightforward. It just pulls numbers from the worksheet. So you really have to complete that worksheet first, which is why we started there, to fill out this first section of Schedule A. Lines 6, 7, and 8 of Schedule A refer to the non-cash compensation for payroll. This is going to be amounts that we can add to the forgivable costs that are not payroll costs, including health insurance, retirement plans, and state and local taxes assessed on employee compensation. There's no $10,000 or $100,000 cap on this, so anything that you paid for these areas can be included on these lines.
So if you just go back to that last slide first. So here's the problem is on that when you're looking at the health insurance cost, this is only for your employees. Now let's go to the next slide. So the compensation to the owner, employee, self-employed individual, and general partners, that goes on line 9. And again, that's just the income. So that's, if you're a Schedule C, that's 8/52 of your 2019 compensation. And we'll talk about how that might change. If you're a W-2 person, that's 15,384. But again, these are not going to be on Table 1 or Table 2. Their guaranteed payments, which is not going to be considered payroll, they'd be in there. So again, what we don't see, which we've had a lot of questions, is where's healthcare and where's retirement costs attributed to owners and general partners? And we're just hoping more guidance comes out. So line 10, so you've made it all the way through line 9, and line 10 is easy. And if you look down there, that's your total payroll cost. You get to add your lines 1, 4, 6, 7, 8, and 9, and you're off and going. Your FTE reduction calculation. So if you have not reduced the number of employees or the average paid hours of your employees between January 1st, 2020 and the end of the covered period, check here, right? So this is kind of like if you got a loan for less than $2 million and you don't want to check the box right there, but here you want to check the box if you're in here because it's a free pass. You have no calculations to do. So make sure you understand if you didn't have any reductions or if you didn't have that reduction in your payrolls for your hours. And then so line 11 is your average FTE during the borrower's chosen period, your total average FTEs, and then the FTE reduction quotient, which is what you're going to divide line 12 by line 11, or enter 1.0 if you have the safe harbor.
So now we get to go back to the application. This is going back to the form that we filled out the name and loan number and everything at the top. There's 4 expense categories that we're going to look at. Line 1 is payroll costs, which you're going to use the amount from Schedule A, line 10. Line 2 is your business mortgage interest payment. Keep in mind, again, this only covers interest. It must be the liability of the borrower or on real or personal property, and it must have been incurred before February 15th of 2020. Line 3 is your business rent or lease payments. The leasing agreement to be included on this line must have been in place before February 15th of 2020. And finally, line 4 is your business utility payments, payments for services of distribution of electricity, gas, water, transportation, telephone, and internet access for services that began before February 15th of 2020. Remember, these are paid or incurred during the 8-week period, and this is potentially outdated. No more than 25% of the loan forgiveness may be attributable to non-payroll costs, but the Act has changed that to a 60-40 rule, and we'll talk about that in the future slides. Next section, line 5, 6, and 7 is the adjustments for reductions. Use the amounts from Schedule A to reduce the eligible forgiveness amount. This may be an hourly salary wage reduction, which you calculated from Schedule A. And then you could also have the FTE reduction part of it too. That's going to also come from Schedule A. So you'll enter those amounts here.
So forgiveness amount. Finally, we're getting to line 8, right? So loan forgiveness is the lesser of the total cost less your salary FTE reduction calculation on line 8. Line 9 is the original loan amount. And line 10 is your 75% rule. And line 11 is your forgiveness amount, which is the total of those. It was just, I'm sorry, the smallest of lines 8, 9, and 10. So, and you made it. So what are your next steps, right? Submit the application to your lender that is servicing the loan. Remember, it's the lender, the bank, is the one who's going to process all this documentation and submit it to the SBA. For the documentation requirements, see page 10 of the application. What I will caution you is your lender may ask for more than what's on that application on page 10, but they most likely will not ask for less. What we found with the application process for the PPP loan was the banks were not in concert in terms of the information that they asked for. And so just to be careful about, you could call us or any other advisor you might have, and they might say, well, you don't need to send them that. My response is always, if the bank's asking for it, let us help you get it to them, because we just want to make sure they're going to forgive your loan, regardless of whether or not the SBA is going to ask for it. And then wait. The lender has 60 days after the date on which they receive your application for forgiveness to issue a decision on the application. Now, having said that, that could change as well with the extension of period of time if you choose a different period of time, if you choose a 24-week, which will come out.
So before we move on to the Paycheck Protection Program Flexibility Act, a few questions that we've received after going through these applications that maybe will answer some of your questions that you have. And So the first one, I normally fund my 2020 retirement plan contribution at the end of the year. Should I push that funding into the 8-week period? The answer is there's not any clear guidance on that. There's nothing that specifically says you can't, but maybe just common sense or internal feeling feels like that doesn't seem right, that you could fund an entire year during the 8-week period, but we don't see anything that says you can't. Nor do we see any issues with, if you have some of your 2019 funding that you still need to do, doing that in the covered period for 2019. Can that be forgiven? We really need more guidance on that. So unfortunately, we don't have a clear answer. What should you consider when opting for the alternative 8-week period? I talked about that a little bit. It's really just going to be laying out the calendar and seeing, could it be more advantageous for you if you were to do the alternative dates? Do the forgiveness requirements only need to be met during the 8-week covered period? That's correct as it relates to the rules of forgiveness. There's obviously rules of the loan that have to be followed throughout the term of the loan, but the forgiveness rules will only be looked at during the 8-week or your covered period. Is wage reduction on an employee or overall payroll basis? It is definitely on an employee by employee basis. So that's where we were talking about the large spreadsheets that you're going to have to put together to track this. And when we applied for the PPP loan, we understood payments of outstanding debt to qualify for forgiveness. Is that still the case? What we're seeing is that it was definitely in the law that those outstanding debt is a qualified use of the loan, but it's nowhere on the application. So it looks like they've taken the position that you can't have the funds forgiven that are used for that, but you could use the PPP loan funds for that purpose. So you're just going to be limited on the forgiveness side unless that was overlooked and we see some additional guidance.
Well, and that was actually in the law too. If you go to, there's an 883-page document of how they documented what you can use the funds for versus what's forgiven. So,
yeah.
So, all right. So then we come into the Paycheck Protection Program Flexibility Act of 2020. And this is what just came out. So borrowers can extend the 8-week covered period to the earlier of 24 weeks or December 31st, 2020. Well, what does this really mean? One is it extends the time to spend the forgivable funds. So what they really were reacting to here is, well, if the whole world was closed and you were one of the first people into the line and you got your money and your store's still been closed for the last 8 weeks, there's been no way, unless you were just going to pay people to sit at home, there was no way for you to use the money. The con is it could make it more difficult to meet the salary and FTE requirements, right? If you have the loan outstanding, you can elect to use the original 8-week period. It could also potentially mean that annualized salaries for a 24-week period is $46,153, replacing any of the references to the $15,384 because you're now dealing with the 24-week period. The other cautionary part is if you use your 8-week period, in some of the guidance that we've read, it said just use your 8-week period and be done because you can cap it. But realize, what if you're not in business on December 31st? Well, that means you don't have the right numbers for your FTE and you may not have anything forgiven. So you could end up in trouble. So again, the FAQs may address this, but so far we haven't seen that. The 75-25 test changes to 60-40s, which says that it used to be you had to use 75% of the loan for payroll costs. Well, now you can just use 60%. But this is dangerous because that 60%, that's a cliff. And so Marcus Rubio, he's actually the senator, he's actually said, wait, this is not the intent. They want to fix it because what it says now is if you don't spend 60%, nothing gets forgiven.
So a few other changes from HB 7010. June 30th, and I alluded to this a little bit going through the application, June 30th now becomes December 31st for penalty and reduction of workforce calculations. We know that this applies to any new loans that are taken out after this goes into effect. What we don't know is if you have an outstanding loan and elect to stick with the 8-week period, do you still get to use June 30th? Because the way it says it in the law is that it strikes out June 30th and that becomes December 31st. It doesn't talk about, if you already had a loan. So we'll need more clarification there. They've also added some new exemptions. Your loan forgiveness will not be reduced if you have a reduction in workforce between February 15th and December 31st, and you can document one of these two things. The first one is that you cannot find a qualified employee to hire, and you must have both of these caveats to it. That would be an inability to rehire the individual who was employed on February 15th, or an inability to hire someone similarly qualified before December 31st of 2020. So you would have to have both of those to qualify for number one. Number two says you're not going to be penalized for your forgiveness if you could not return to the same level of business that you had as of February 15th due to compliance with requirements established or guidance issued by the Secretary of Health and Human Services, the Director of Centers and Disease Control and Prevention, or Occupational Safety and Health Administration during the period March 1st ending December 31st. And all of this related to COVID or social distancing or any other worker or customer safety requirements. So basically, if you are forced to stay shut down, you're not going to have to be penalized there. Finally, the last 2 points of the new bill, the repayment deferral period was extended. Loans that do not qualify for forgiveness can be repaid over 5 years instead of 2 years. Payments on these loans can be deferred until the date on which the SBA makes a determination on your loan instead of a flat 6 months. So prior to this, after you get out of the forgiveness period, you would have had 2 years to pay back the loan. Now you have at least 5, and your payment on the loan is deferred until you figure out what you actually get forgiven by the SBA. Technically, this only applies to loans made after the passage of this bill, but lenders and borrowers are free to renegotiate the terms of your existing loan. So if you have an outstanding loan and you want to make sure these terms are part of it, go back to your banker and make sure the loan documents are amended to reflect that. The interest rate is remaining at 1%. Also, something that came out with the CARES Act, but that was previously limited to people who received the PPP loan, is the ability to delay paying in the employer's portion of Social Security tax that would otherwise be due from the date of enactment through December 31st of 2020. Now, recipients of the PPP can take advantage of this delay, and that delay is that you don't have to pay anything during 2020 on the employer's portion of Social Security, and instead can pay 50% December 31st of 2021 and another 50% December 31st of 2022. So maybe that will help you cash-wise. One could argue it may be hard to guarantee that you're going to have that cash at the end of 2021 and 2022 to pay it in, but that is an option. Also, if you're part of a PEO, the election to defer these payments is your option. So you can let your PEO know that you want to take advantage of that.
So just some questions. Is cash compensation limit going to go from $46,153 instead of $15,385? We're going to have to just wait and see. Will this change the cap for forgiveness from compensation to owner employees to be the lesser of $46,153? There's a small typo there. It should be 24/52 of the 2019 compensation. And then I'll just dovetail that to 2 and 3. In that the answer is it would make sense. It would really mean that for for Schedule Cs and owners, you may not, if you're a single sole proprietor, you might get it all forgiven because you can stretch it out. Do you have to wait until the 24-week period is over to apply for forgiveness? Well, it says December 31st or 24 weeks, whichever one is earlier. Also, if you stick with the 8 weeks, the assumption would be that you could apply as soon as your 8-week period is done. And so my gut is that June 30th is going to survive due to FAQ 17, which talks about if you relied on previous guidance. But again, we're going to have to let someone else tell us that. As we know, the Treasury Department amounts paid with forgivable funds will not be deductible. So if you stretch this out until December 31st and are waiting on the forgiveness calc, how do you file your 2020 tax return? We're going to have to see that as well. There's going to be more FAQ guidance. The other which we didn't bring up before, if you're relying on an FAQ, make sure you print it. If you don't print that FAQ, then you may be out of luck when you're trying to prove your case if somebody says, hey, you weren't supposed to do that. Just, there's another disclaimer. There are several things coming out, and we will, if you just go to our next slide real quick. So what we do have is, if you go to our website and our tax alerts, like for instance, we came out with about the 70-10 rule. We actually came out yesterday morning with the tax alert. So I would encourage you to go sign up on our website on the upper right-hand corner. We also have an email address. So I know we're going to try and address some questions here, but if you need to drop off, there's also a caresact@whitleypenn.com. We just ask that you try and give us at least 24 hours to respond to you, because it's getting flooded at the moment. And with that, I'm going to toss this back over to Neil.
Thank you so much, John and Kristen. This was a very comprehensive overview of PPP forgiveness and even EIDL loan implications. So thank you so much for that. We do have a few questions that came into our Q&A box. I want to let everybody know, if you do have a question, we have about 5 or 10 minutes left. So we will field as many questions as we can in that time. So you can enter your questions into the Q&A box. Our first question, John and Kristen, is what are the rules on affiliates to check the box if the loan is over $2 million? If there are different partners in companies, but some partners in all of the companies, will they be affiliated?
Wait, yeah. Ask that question again, because the affiliated rules has to do with the 500 employee portion. Not so if there's less than 500, then they wouldn't be, each company would have been handled separately. So it's a matter of the 500 or more. And that's much more about an SBA guideline versus a tax guideline of ownership. So I'm not sure, I might not be answering the question and you may need to repeat it again, but if they're looking at the affiliated rules for the SBA, it just has to do with 500 or more employees, whether or not they were allowed to have the PPP loan.
So I'm going to request that the submitter of that question please clarify if that question wasn't answered. The next question we have is the earliest a forgiveness application can be submitted is 8 weeks after the disbursement date. Is that correct?
I'm going to waffle a little bit on this one. The lenders are going to guide this. So we had previously asked a bank to do these. We asked several banks actually to do one of these forgiveness webinars with us, and nobody wanted to be recorded saying anything regarding when this was all going to take place. What a lot of banks are doing is they're automating it, and that you're going to just go in and put everything online. It should be after 8 weeks. Having said that, I'm kind of on the front lines that I deal with a family business, and in that family business, we have not seen anything coming from the bank to go in and put in for the loan forgiveness yet. So I can't, but the answer is it should be. But whether or not it's going to be, they're going to wait for the June 30th payroll tax reports to come out because they want that information. We just don't know, right? But
yeah, and I think there's some of the calculations that you would need the full 8 weeks. There's nothing that says if you spend all the money in 4 weeks, then your calculations, get to be reduced to 4 weeks. So I think you're probably going to need to wait the 8 weeks to submit the application.
But I think your lender's going to tell you when you can do it.
That's right.
All right. Our next question is, does the 8-week period only commence from the loan disbursement date, or can it be retroactive to an earlier date?
It's only going to be from the disbursement date unless you choose that alternative period that would delay it. That alternative period, I believe, has to start after the disbursement date, and it would be the first payroll period that begins after your disbursement date.
And relatedly, how do I document payroll if I'm a self-employed contractor with no other employees?
Schedule C.
Schedule C.
A self-employed person fills out a Schedule C, and that calculation is just simply right now 8/50 seconds of line 31 of your Schedule C. And what we've been advising, for support of that is if you have a business bank account that the loan was deposited into, somehow make a transfer or write a check or move that money out of your business bank account into your individual bank account, 8/50 seconds of whatever your line 31 was on your 2019 Schedule C, move that during the 8-week period. And that's really all the support you can show, because you won't receive a W-2 or file a payroll return or anything like that.
And we had another question here. Please go over the owner-employee allowed compensation that goes into line 9.
That's going to be capped at $15,835. So it's what,
I'll go back to that slide.
Yeah. So it's I don't remember what slide that was.
Yeah.
But it's 15,003. I said 385, 384, and then if you're a sole proprietor or a general partner getting a guaranteed payment, then it's 8/50 seconds. So again, it's no health care and it's no retirement cost. In fact, there's a lot of conversation early on as why shouldn't I just go fund, if you're a single owner and you make a decent penny, why shouldn't you just go fund a defined benefit plan with hundreds of thousands of dollars? And clearly they cap this. So,
and I think this is an area that we were hoping for more guidance on, because it was new information as this application came out that it's going to be capped at the lesser of the 15,834 or 8/50 seconds of 2019 compensation. You might have been in a position that your business started in December of 2019, so your compensation was very low. Or the example that keeps being brought up is, it's always been really advantageous to an S Corp owner to pay himself a reasonable wage that is quite low, justified but low. Well, now you're being capped on your forgiveness based on that compensation, and so this may very well end up where out as it is right now, but there's been enough concern about this area that maybe they'll revisit it, or at least give some more guidance on it. But it's pretty much as straightforward as is outlined there in orange on the screen.
Right, and Neil, I just want to make sure we have time to say this, that when the application came out, the SBA said they were going to come out with at least 30 FAQs within a week. And what happened is I think they were looking and saying, oh, we think there's going to be new legislation. So they haven't even issued those yet. So we're hoping that they were busy writing most of them. And so we're going to get those FAQs and receive that guidance fairly quickly. And it could be as early as today, and it could be the first part of next week, which may even bring to a close some of these questions that everybody has too.
For sure. And I will let all members know that we will be putting those questions out, the FAQs out, once they are released. We do receive your tax alerts, John. So
Perfect.
when y'all put those out, we will put them out in our newsletter.
Great.
We have one more question. I think this is the last question we have time for today. If we received funds on 5/1 and then 56 days, and then the 56 days are till 6/25, do we take our semi-monthly payrolls paid within that pay date, or can earlier dates be taken since it covers the period prior 2 weeks?
Yeah,
That's
I think
paid.
the slide you want to pay attention to, that I'll go back to here, is the specific for payroll cost. Payroll is considered paid on the date that the paychecks are distributed to the borrowers or originates an ACH credit. It's also assumed incurred on the date that the wages are earned. So the two examples there, if your pay period is for April 1st through April 14th, you receive the loan on April 16th and you pay the payroll on April 18th, you can use forgivable funds for that pay period, though it was outside of your 8 weeks, because you paid it during the 8 weeks. Alternatively, the second example is if your pay period ends the last day of your 8-week period and you pay your employees the next day, Because that payroll was incurred during the 8 weeks, you will be able, even though you paid it outside of the 8-week period, you will be able to include that in the forgiveness, as long as it's paid before the next regular payroll.
Well, those are all the questions that we have today. And I actually think we got, one last question, if we can fit it in. Any exceptions on 501c3 nonprofits?
Expand that question. In other words, I mean, the PPP loan's out there for them, but when you're saying, well, I mean, there's plenty of exceptions, but the question, well, let me rephrase that. I don't think there's going to be exceptions outside the scope of what we've spoken about.
Okay.
But again, I'm not sure what they're looking at. So
Yeah. Well, I would encourage everyone, if you have any follow-up questions, to reach out to the link that Kristen and John shared, caresact@whitleypenn.com. They will help to get those questions answered quickly. And with that, I want to thank John and Kristen, and also Rebecca and Kristen Lawler, for all of your efforts to educate our membership today. Thank you so much for being a valued member of our chamber. And if any of you are interested in learning more about the chamber, you can reach out to us at info@usicoc.org. Thanks again, and I hope everyone has a wonderful weekend, and I hope you all stay safe. Thank you.
thank you.
Thanks.